The auctions are jamming, not failing, not collapsing, jamming. Government bonds hit the market, and buyers aren't rushing in like they used to. Demand is thin, hesitant, calculated. Yields are staying elevated when they were promised to fall. Primary dealers are absorbing supply they don't want, and the stress is immediate, not building, not approaching, already here. The machine that's supposed to turn sovereign debt into cash smoothly, automatically, reliably, it's grinding. And if you're waiting to see where this goes, you're already behind. The people moving real money already repositioned. They saw the jam coming, and they're watching you discover it in real time. Fresh government bonds were supposed to clear easily this week. The setup was perfect. Policy signals suggested easing. Markets expected relief. Investors were supposed to be hungry for duration. The narrative said, lock in these yields before they fall. Buy now. Get positioned. The bonds will sell themselves. Except they didn't. The auctions opened. Supply hit. And the buyers who were supposed to rush in held back. Not dramatically, not with announcements, just quietly, subtly. Enough that the bid-to-cover ratios looked thin. Enough that dealers had to step in heavy. Enough that yields stayed pinned at levels that weren't supposed to hold. This shouldn't be happening. Government bonds are supposed to be the easiest sell in finance, the safest asset, the thing institutions have to own. When a developed sovereign issues debt, the world buys it. That's the foundation. That's what makes the system work. Banks need government bonds for liquidity. Pension funds need them for safety. Insurance companies need them for regulatory compliance. Foreign central banks need them for reserves. The demand is supposed to be structural, built into the architecture of global finance. So when auctions open, buyers appear, automatically. The bonds get absorbed. The government gets funded. The system continues. But the buyers held back. The orders came in slower, smaller, more conditional. The big institutional allocations that used to anchor these auctions looked reduced. Foreign participation looked weak. Domestic buyers demanded higher yields before committing. And the dealers, the firms required to bid, required to support these auctions, had to fill the gap. They had to absorb what the market wouldn't take. And now, they're sitting on inventory they don't want, at prices they're not comfortable with, hoping the next wave of buyers shows up before the next auction forces them to absorb even more. The timing reveals everything. Markets were supposed to be calm right now. Reassurance was promised. Easing signals were sent. Conditions were supposed to improve. Borrowing costs were supposed to fall. And into this environment of expected relief, government bonds hit the market and met resistance. Not panic, not crisis, just resistance. The market looked at the supply, looked at the yields, looked at the promises of easing, and said, not enough, not yet. Show us better prices, prove this is worth it. And while the market hesitated, the auctions had to close. The bonds had to be sold. And the dealers had to make it happen. This keeps happening. Every major issuance now shows the same pattern. Auctions that used to breeze through with robust demand now struggle. Yields that used to compress when supply hits now stay elevated. Bid-to-cover ratios that used to signal strength now signal caution. The market that used to absorb sovereign debt automatically now evaluates it, questions it, demands to be convinced, and every auction that reveals this hesitation makes the next auction harder. Because buyers see other buyers holding back, and no one wants to be the last one buying while everyone else is repositioning. The yields are telling you what the officials won't. They're staying high because the market has stopped trusting the narrative, stopped believing that easing is coming soon enough or strong enough to justify locking in at current levels, stopped accepting that government debt at these yields offers adequate compensation for the risks that are building. The yields aren't spiking. They're not crashing. They're just refusing to fall. And that refusal is more dangerous than a spike. Because a spike is obvious. A refusal is subtle. It creeps. It persists. It embeds itself in every transaction until suddenly everyone realizes the market has fundamentally repriced sovereign risk, and no one can remember when it started. This benefits someone. Always. The primary dealers are positioned to extract maximum value from the jam. They're required to bid, required to step in when the market won't. And they're doing it, but they're charging for it. They're widening their spreads. They're marking up the bonds before flipping them to secondary buyers. They're extracting a toll for providing liquidity that used to exist organically. And that toll comes out of government coffers, out of taxpayer money. Every basis point the dealers extract is more interest the government pays, more debt service, more fiscal pressure, more money flowing to banks for doing what the market used to do for free. The sophisticated funds saw this developing. They reduced their government bond exposure weeks ago. They shortened duration. They moved into cash. They positioned for exactly this scenario, where supply meets hesitation and yields stay elevated, despite promises of easing. And now they're waiting, calculating, watching the auctions jam, watching the dealers absorb inventory, watching yields refuse to fall, and they're deciding when to come back in, when yields are high enough, when compensation is adequate, when the risk-reward finally justifies the allocation. But not now, not while the jam is still forming, not while other buyers are still stepping back. This hurts you, directly, immediately. If you pay taxes, more of your money is going to service government debt that just got more expensive to issue. If you're trying to get a mortgage, the bond market just jammed and kept your borrowing costs elevated. If you're holding government bonds in any account, retirement, savings, investment, the auctions just showed that demand is weak and your asset values are under pressure. The jam was supposed to be invisible, technical, a back-office issue that gets resolved quietly. Instead, it's creating stress that's radiating through every rate-sensitive corner of the economy and landing on you. Here's the mechanism destroying you. Governments fund themselves by issuing bonds. When demand for those bonds is strong, yields stay low. Low yields mean low borrowing costs. Low borrowing costs mean manageable debt service. Manageable debt service means fiscal flexibility. But when demand weakens, when buyers step back, yields rise. Rising yields mean rising borrowing costs. Rising borrowing costs mean more money going to interest payments. More money to debt service means less money for everything else. And those higher yields don't just affect the government. They ripple through the entire economy. Mortgages price off government bonds. Corporate debt prices off government bonds. Every rate in the economy is anchored to the sovereign curve. And when the sovereign curve jams, everything jams. The market depth has evaporated. That's the core problem. The auctions used to be able to absorb massive supply without stress because the buyer base was deep, diverse, and automatic. Foreign central banks would show up. Sovereign wealth funds would participate. Domestic institutions would bid. The demand came from everywhere. But that depth is gone. Foreign buyers are cautious. Some are actively reducing holdings. Domestic buyers are selective. Dealers are the only guaranteed bid, and dealers can't absorb unlimited supply forever. They have balance sheet constraints, capital requirements, risk limits. So every auction that forces them to take down more supply pushes them closer to their limits. And when they hit those limits, the auctions don't just jam, they fail. The dealers are bleeding. They're required to support these auctions. It's part of their agreement with the central bank. So they bid, they absorb, they warehouse inventory. and then they try to distribute it to real buyers. But real buyers aren't showing up. Not fast enough. Not in size. So the dealers are stuck, holding bonds they don't want, tying up capital they need for other activities, watching their positions lose value as yields drift higher, and praying the next auction doesn't force them to absorb even more before they can clear what they're already holding. This won't stop, because governments can't stop issuing. The bonds maturing have to be refinanced. The deficits have to be funded. The operations have to be financed. There's no pause button. No way to wait for market conditions to improve. The auctions are scheduled. The supply is coming. And a market that's already showing stress has to keep absorbing. Next week, there's another auction. Next month, there's another wave. Every quarter, more supply, and buyers who are already hesitating, already stepping back, already demanding higher yields. They have to keep absorbing, or the system breaks. The jam is getting worse with each auction. The first signs were subtle, slightly weaker bid-to-cover ratios, slightly higher yields, easy to explain away as noise, but the pattern is repeating, strengthening. Each auction shows more hesitation, more resistance, more reliance on dealers to fill the gap. And everyone in the market is watching. Every buyer sees other buyers holding back. Every dealer sees other dealers absorbing unwanted inventory. Every analyst sees the metrics deteriorating. And no one wants to be caught on the wrong side when the jam becomes a breakage. The next auction in days decides if confidence snaps. More supply is scheduled. More bonds hitting a market that just showed it's not ready. And the buyers who stepped back last time have to make a decision. Do they come back? Do they demand even higher yields? Do they stay away and watch the dealers struggle? Every participant is calculating. Every institution is assessing risk. And the government has no choice. The auction happens. The bonds get issued. The supply hits. And either the market absorbs it grudgingly, expensively, or the jam becomes visible to everyone. If the next auction shows the same pattern, the narrative changes. Media coverage intensifies. Analysts start writing about sovereign debt stress. Investors start questioning fiscal sustainability. Other governments start worrying about their own auctions. The jam that's been building quietly becomes a story, and stories move markets. Once the narrative shifts from temporary technical weakness to structural demand problem, positioning changes, fast, violently. Buyers who are hesitant become sellers. Holders who are patient become nervous. And the yields that were just stubbornly high start spiking. This feels like the first visible crack in the debt absorption machine. Not the first crack. The first visible one. The cracks have been forming for months. Buyers reducing allocations, foreign holders selling, dealers absorbing more. But it was gradual, quiet, deniable. The auction still cleared, the system still functioned, the narrative held. But now the cracks are showing in the auction results. In yields that won't fall, in demand that won't materialize, in dealers that can't hide the stress anymore. The machine that turns sovereign debt into cash is supposed to be invisible, frictionless, automatic, and it's becoming visible, grinding, manual. You're holding assets in an economy where government bond auctions are jamming, where the safest bid in the room is hesitating, where yields are staying high despite promises of easing, where the mechanism that's supposed to fund everything smoothly is showing stress, and you're positioned as if none of this matters, as if the auctions will always clear, as if sovereign debt will always find buyers, as if the foundation of the entire rate structure is solid when it's actually starting to crack. The government needs to borrow, constantly, massively, and it needs the market to absorb that borrowing at manageable yields. But the market is stepping back, not refusing, just hesitating, evaluating, demanding more. And every auction that shows this hesitation makes borrowing more expensive, makes debt service heavier, makes the fiscal situation worse, which makes buyers more hesitant, which makes the next auction harder. The feedback loop is forming, the jam is building, and every day it continues, the pressure increases. The mortgage you're trying to get prices off government bonds. The bonds just jammed. Your rate stays high. The retirement account you're relying on holds government bonds. The bonds just showed weak demand. Your balance is under pressure. The tax burden you're carrying includes debt service. The debt just got more expensive to issue. Your burden increases. Every corner of your financial life connects to government bond auctions clearing smoothly. And the auctions aren't clearing smoothly anymore. The primary dealers are repositioning their entire approach. They're demanding wider spreads, higher compensation, better terms, because they know what's coming. They know the next auction will be harder, the one after that, harder still. They know the jam is building and someone has to absorb the loss when it breaks. And they're making sure it's not them. They're extracting maximum value now while they still can, before the market realizes how bad the jam actually is. Before the narrative shifts, before the visible crack becomes a visible break. The buyers who stepped back aren't coming back at these yields. They're waiting for better prices, higher compensation, clearer signals, and the government can't give them better prices without accepting higher yields. Can't give them higher compensation without increasing debt service. Can't give them clearer signals without admitting the situation is worse than it looks. So the standoff continues. The jam builds, the auctions struggle, the dealers absorb, and the pressure mounts. You're watching sovereign debt, the safest asset in the financial system, lose its automatic bid. Not in a crisis, not in a panic, just in the quiet hesitation of buyers who used to show up automatically and now don't. In auctions that used to clear easily and now jam. In yields that used to fall on easing signals and now stay stubbornly high. The foundation is cracking, not breaking, cracking, and you're standing on it, waiting to see if the crack stops spreading or if the next auction turns a crack into a break. The next auction is days away, more supply hitting a market that just showed it's not ready, and everyone is watching. The dealers who just absorbed inventory they don't want, the buyers who just stepped back, the government that needs the auction to clear, the taxpayers who will pay the cost if yields spike, the mortgage holders who need rates to fall. Everyone connected to the sovereign debt market, which is everyone, watching to see if the jam clears or worsens. If confidence holds or snaps, if the machine restarts or breaks.